Welcome back to the channel of truth, trust, and transparency. Today, I'm answering another one of your questions regarding buffers in your portfolio. It's important before we dive into this to realize that this is not financial advice. This is simply opinion and education. And a lot of the examples that I'll use today is going to be based off my current situation. So remember, I can't do this video based on what your situation is. I'm not too sure. So take this video as a chance to learn and get opinion from someone like me, then to take your own situation into consideration to decide what you can do for yourself. Now, the question comes in on Instagram. I will keep the name anonymous, but I'll read the question. Also, mate, a really good question that I think you would ace would be around buffers. Every time we pull out equity, it's a catch-22 of, do I use that to go all in on another investment, using up most of our buffer, or do we keep a certain buffer, i.e. 125K will get us into another property, or do I keep that into an offset? What sort of ratio should you have a buffer of to the amount of properties you have? Again, you may have already spoken about this, but I think buffers and offsets, something we could learn a lot from you about. Really good question. And it's going to, buffers are really a measure, in my opinion, of your risk appetite. Now, I see people, taking a very conservative stance on buffers. However, it definitely just depends on your particular circumstance, what you're doing for work and income, and how quickly you can build up buffers, especially in cash, and also what part of that sort of portfolio you're in. If you're in the accumulation phase, maybe you want to leave less in terms of buffers per property there so you can get the buying out of the way. Then after you transition from accumulation to that sort of hold phase is when you want to build up offsets and buffers. There you have not much risk, right? To break this down in a little bit more detail, I think the best time as well, and you know what I would preference, or how I would work my property portfolio is, let's just say that you have, and again, remember I'm running this episode off not knowing how many properties that you have. Obviously, the bigger the property portfolio, the more the risk. If you've got one or two, it is quite low risk. However, what I would do and how I would start to structure it. Now, we know usable equity, usable equity equals value times 80% minus loan. So first and foremost, I think what smart investors do is when a property has increased significant in value and you have usable equity to a substantial amount, not $10,000, $20,000, I would say in the likes of $50,000, $60,000, $70,000, that's when I'd be pulling that out and putting that in my offset account. So let's run through a little bit of a scenario so you guys get what I mean. Now, you've bought a house for $500,000. Okay, your loan is, let's say, $440,000. Now, your property increases. So my property increases to $700,000. My loan is still $440,000. 80%. Let's do the equity calculation. 80% of this fee, 80% of this amount, 80% is 560K, right? And we have a loan of 440. We have a loan of 440, meaning we have 120K of usable equity. Now, If you can access the equity and you can service the equity, I would get it out. I wouldn't leave it in there in the property and not have it there. To me, as soon as my property, so step one is once my property has grown in significant value to access a substantial amount of equity, in my opinion, that's probably 50 to 75K minimum. Then I want to do the equity release. I want to do the equity release so that I can park this amount in the offset that is attached to this home. So I'll have a 440K offset, and then I'll have a 120K offset. Now, I want to make sure with this particular house that the equity is there and ready to go. A lot of people will make this mistake. They will have the house, it would have grown in equity, then they'll go shopping or try to find something, and then it's a rush to refinance, go through the bank process and all that kind of stuff. I would get it out straight away, because if you can leave the 120K cash in the 120K offset, or offset it against the house, that is a substantial buffer across a few projects. Now let's talk about, Dave, how much money do I need to allocate for the property? Take this purchase, for example. I've got a $440,000 loan, a $700,000 value. A $440,000 loan in repayments is going to cost me $25K per year. We know as well from the other videos that I've done on my channel is that the property also has about, at this particular price range, has about $10,000 of other costs per year, okay? So it's going to cost me $35K. If I don't have it rented out, it's going to cost me $35K. When I divide that, my friends, by 12, it's about just under, but we'll round up. It's going to cost me $3,000 per month. For me, and me personally, a 2 to 3 month buffer for me is sufficient. Now you have to assess your own situation here and think if it is or if it isn't. I don't know if you have kids, family, mortgages, all other loans, but for me, 2 to 3 months. So in this case, 6 to 10K sitting in the offset per property. Now let's play this out a little bit and let's think about it. It is highly unlikely, if you have purchased a property in a suburb that has the right data metrics, that has the right vacancy rate, that has the right demand and supply, that your property is going to go 2 months, your residential property is going to go 2 months plus vacant and having no tenant in there. Think about that. That is a very long time. Now, you might say, Dave, but what if there is an issue that happens? Well, that's where I would ask you, your property should be or will be insured by landlord's insurance. So if there's natural disasters, and read the PDFs, maybe as a checkup, read the PDFs, go through that. But natural disasters, if there is any issues with that particular property, with the tenant doing something, with the tenant damaging, majority of those policies will help provide and pay you you'll be insured for a series of rent until that property is finished. So to me, 2 to 3 months, I would say err on 3 months just to be safe and have $10,000 per property. A lot of people say 6 to 12 months, but when we start adding that up, 20 grand, 40 grand per property, it starts to be a lot across your portfolio. So for me, if I've got 10 grand against this particular property, I know that there's likely going to be no costs such as an air conditioning or a hot water system that are going to keep me up at night, because I've got $10,000 sitting there ready to replace any of that stuff. I know that if my tenant trashes the joint, that it is insured, that I will get paid out that rent for the time that the property needs to be fixed and back onto the market. So there's not a lot of stress there. So for me, the amount per property, we're looking at about 3 months of those holding costs. So in this particular case, I'd aim for about 10 grand on that particular property. Now let's talk the number of properties in your portfolio. Ideally, you do have this amount for each property. The likeliness of you having, say, 5 properties, let's just play this out. 1, 2, 3, 4, 5. So if you've got 5 properties and you say, Dave, it's a lot of money. It's a lot of money to keep in offsets. I would say, yeah, look, I agree. It's $50,000. And you're looking to make a purchase. What I would recommend is that you don't use your entire offset or your entire buffers across your entire portfolio to make that new purchase. Again, one property going up in value here gives me 120K in offset. I would need to have 12 properties, more than 12 properties for me to be scared and not be able to cover this buffer, and not me to be scared because I don't have enough money. So to me, I would typically, if I had to take money out per 5 properties, if you're asking me personally, and my rule of thumb would be, keep enough buffer for 60% of the properties. So if I was tight, let's just say I was tight here, right? Let's just say the property hadn't gone up. Let's say I pulled out 80K in equity and I wanted to go again. I could service it and I needed 100 grand. If I can pull out 80K equity, I then dip into, me personally, 2. I'd grab the cash out of here to get to my 100K. I think once you start going 3 or 4, you do open yourself up for risk, because, my friends, Murphy's Law will tell you is that anything that can happen will likely happen. So if you go out there and go, I'm going to take all 50, then you're going to get a call the bloody next day saying, oh, my air conditioner broke, my hot water system's broke, blah, blah, blah. And what you also need to assess yourself in your own portfolio is, what is the condition and what are the types of these properties? Because if they're all, weatherboard shacks that are 60, 70, 80 years old, then you need to leave some money in there. If they're sort of newer builds, you would know then that your risk is a little bit lower, because the likeliness of there being major repairs required is going to be lower because they're newly constructed. You've had a building and pest report done. You're getting your regular pest and termite sprays. You know the condition of the house. So if you are, and a general rule of thumb to work off, in my opinion, is if you've got 5 properties and you want to take out some money from the buffer, I would say try to keep a buffer across 60% of the properties. If you've got 3, I would say try to keep it 1 across 2. If you've got 2, keep it across 1. But then, ladies and gentlemen, the first thing you must do after you've bought the property, that next property, is attack and put together a 10K savings mode. Now, if you can save, for example, $1,000 a fortnight, it's going to take you 10 fortnights. It's going to take you 20 weeks. It's going to take you 5 months to save back up that buffer. But the good thing is that when you have a portfolio of 5 properties, you have a little bit of you can become more, how do I say this, creative, because you might be able to do an equity release on either of these, right? One of these could have grown. You can do an equity release, be able to take out money. Now, it's not recommended, but you can be a lot more creative if you have more properties in your portfolio. But for me, I want to make sure that if I've got, for every 5 properties, I want to leave the buffer on at least 3 if I'm making a new purchase. Don't take this buffer off just for anything or to buy a jet ski. If it's you needing to get into a next purchase, I would keep a buffer across 60% of your portfolio to then go into and buy the next one. But as soon as you do buy that, then work on replenishing that portfolio, working, replenishing that buffer. If you can, and what I always say with deposits and with buffers, if you can do it in cash, it's a lot safer than if you're doing it in equity, because the equity obviously comes with a cost. That is a loan from somewhere. Yes, you can sit it against itself, so you're technically not paying anything from it. But if you can have a cash buffer in there, it just makes it so much easier. It's easier to put cash in that account than it is equity, because you've got to wait for that property to grow, then you've got to refinance and get the equity out. So cash can be a lot quicker. Either or will do, but that's how I would calculate it. So if you're watching this, and to summarize like I try to do on my videos, remember, hit subscribe if you're just watching and you don't subscribe it yet. I'm trying to get to 2.5 by the end of the year. This is what you're going to do. For each property, you're going to calculate what 3 months worth of holdings is. To me, for this particular example, 500K purchase, that went up to 700 with a 440K loan at 5.7%. We're getting down into the fives interest rate, guys. How good is that's 10K. So 10K, I know the world falls in that particular property. It's insured with landlord and contents insurance, or just landlord's insurance. I know if there's anything that the tenant does, I will be covered by my insurance policy. So at the end of the day, 3 months is an extremely long time for any decent market in Australia for that house to be vacated. And I'd ask you why it would take so long. In this particular instance, it's 3K a month. We've rounded up 10K per property. If you are then using, now you might say to me, this is totally discretional, but for me, that helps me sleep at night. You might need six months worth of expenses to help you sleep at night. I'm going to leave that up to you to decide. To me personally, 3 months is an extremely long time. 12 weeks trying to get something rented out. Even if you got to drop the rent, even if it's a competitive market, you got to drop the rent $10 a week to get it rented out. It's better than trying to chew through all your offset and savings. So for me, step one, assess the cost of each of your properties. Step two, figure out what is the runway that you think you need. For me, it's about 3 months. For you, it could be a lot more. Then we make sure we build that up against every property in our portfolio. So 10K across the portfolio. If you feel like you've got too much money in buffers and you need to make another purchase, I would recommend maintaining buffers on 60% minimum of your portfolio. So if you're digging into any of these baskets, if you're digging into your buffers as cash for new purchases, I would recommend keeping 60% with buffers and taking that 40%. You might not be able to save this you might not be able to say that, or that might take you a while depending on how much you earn and how much you can put away. So your other alternative, and what you should be thinking about and doing as well, is when that property grows significantly, remember 5 to 75K minimum, I'm getting that refinance and I'm sitting that equity in an account, in that offset account, so that is ready to go. And you can use that as well as a buffer as safety, as well as working on these. Or you might just say, Dave, in this particular instance, I'm happy to keep 60K. I've got 60K on an offset, ready to make my next purchase. I'm using that as my buffer. But also remember, why it's good to have the cash in there is because this 60K, I might use it with 40 grand of my cash to make my next purchase. Then my total buffer's gone. So ideally, if I'm saying 100 grand is going to be my next purchase, and I've got 5 properties, right? And I've got 30 grand in cash. Let's work this out. I need 100 grand. So realistically, I need 70K in equity to plus on my 30K cash to get into that property. Now, if I'm using that equity, if I'm using this equity here as my buffer, then technically 70%, $70,000 should be 40% of this amount here. Does that make sense? So if this is the particular case, right? So if I have these 5 properties and I've got 70 grand in equity, I'm going to leave 30 grand, 30K buffers. Then I've got 40 grand out of that 70 grand left for deposit. And then I've got 30 grand of cash. So I've got $70,000 of, I've only got 70K. So there I'm 30 short. In that instance, I wouldn't take this 30 grand, use 100 grand to get me into the market. Why? Because then I've exposed my entire portfolio. I've exposed my entire portfolio. I've got no buffers. One thing goes wrong, I'm cooked. So always save that buffer of 60% of your portfolio as a bare minimum. Any questions from this, guys? Let me know. As usual, thoughts, queries, comments, drop them down below. If you have a question, reach out to me on Instagram. It's hard on YouTube to have sort of a back and forth chat with someone. But as always, I'll see you guys tomorrow.